Good morning, Doctor. I'm Chong Eugene with the matrix number of 298256. Today, I will be presenting on credit risk management with a particular focus on Hong Leong Bank Berhad, or also known as HLBB. This presentation is based on a detailed analysis of the bank's internal and external risk factors from 2014 to 2023. Hong Leong Bank Berhad is a part of the Hong Leong Group. It was founded in 1905 and is headquartered in Kuala Lumpur. It offers a wide range of services including retail, commercial, Islamic, and investment banking. As of 2023, HLBB reported a net profit of 3.8 billion ringgit and managed assets worth over 260 billion ringgit. What distinguishes HLBB is its strong digital banking innovation and its consistently low gross impaired loans ratio, indicating disciplined credit practices. Now, let us discuss the problem statement faced by Hong Leong Bank Berhad. The first one will be hidden risk. Despite being good performance metrics, there may be underlying credit risks that are not immediately visible in financial reports. These include sectorial concentration in lending, overexposure to specific borrower segments, or underestimating long-term default trends. Such hidden risks can accumulate over time and unexpectedly impact the bank's credit quality. Secondly, it will be digital disruption. While Hong Leong Berhad is a leader in digital banking, this transformation brings its own set of risks. Automated credit scoring and loan processing systems have created issues like inconsistent credit assessments and even last-minute loan cancellations. These systemic-based decisions can reduce transparency, frustrate customers, and increase operational risk if not properly managed. The last one will be macroeconomic shock. External economic pressures such as the COVID-19 pandemic, rising inflation, and interest rate volatility have affected borrower repayment capacity, especially for SMEs and unsecured consumer loans. These shocks have forced the bank to raise its loan loss provisions to cover potential defaults, which signals increased credit risk on the horizon. Now we are going to discuss on research objectives and research questions. The first objective will be to examine the impact of internal or bank-specific factors on credit risk at Hong Leong Bank Berhad. The second one is to assess how external macroeconomic factors affect credit risk. The last one will be to evaluate the combined effect of both internal and external factors on the bank's overall credit risk. For the research questions, the first one will be, do internal financial factors significantly affect the credit risk of Hong Leong Bank Berhad? The second one will be, do external macroeconomic variables have a measurable influence on credit risk? The last one will be, what is the combined effect of internal and external factors on Hong Leong Bank Berhad's credit risk? Next, we will now do the literature review of the variables that are involved in this study. Below are the four most important variables that are involved in this study. The first one will be credit risk. Credit risk refers to the possibility that a borrower fails to repay a loan. It directly affects a bank's profitability and stability. Managing credit risk involves strategies like credit scoring, collateral requirements, and diversification. It's one of the most critical risks for financial institutions like Hong Leong Bank Berhad. Next one will be loan loss provision. Loan loss provision is the amount a bank sets aside to cover potential loan defaults. It acts like a safety buffer against credit losses. A higher loan loss provision usually reflects growing credit risk. In our study, loan loss provision was the most significant variable positively correlated with credit risk. The third one will be ROITALO. ROITALO stands for Return on Investment in Total Assets and Liabilities. It measures how efficiently the bank use both its assets and liabilities to generate returns. A higher ROITALO suggests better financial efficiency, which may help reduce credit risk. Although not statistically significant, it remains a useful performance indicator. The last one is macroeconomic factors. Macroeconomic variables like inflation, GDP, and interest rates are commonly linked to credit risk. However, in Hong Leong Bank Berhad's case, most of these did not show significant impact. Only the exchange rate has a strong effect, indicating the currency stability helps lower credit risk. This suggests Hong Leong Bank Berhad is mostly driven by internal factors rather than external shocks. For the methodology of this study, we have four steps. The first one is sampling method. For this study, Hong Leong Bank Berhad was selected due to its strong market presence. We collected the financial data from its annual reports between 2014 and 2023, covering a full 10-year period. This provided a consistent and reliable sample to assess how internal and external factors influenced the bank's credit risk over time. The second one will be statistical technique to examine the impact of various factors on credit risk. We used the ordinary least squares OLS regression method. This allows us to measure the relationship between one independent credit risk and multiple independent variables such as ROITALO, liquidity, and macroeconomic factors. Followed by the data analysis. All financial data was organized and calculated in Microsoft Excel, where key ratios were derived and trend graphs were plotted. This helped visualize the performance of variables like loan loss provisions and liquidity over the 10-year period before statistical testing. The last one will be SPSS analysis. We used IBM SPSS Statistics version 28 to run the regression and correlation analysis. SPSS provided accurate outputs, including model summaries, coefficients, and p-values, which helps us identify the most influential factors affecting Hong Leong Bank Berhad's credit risk. Now, we will proceed with the findings and analysis. From the right side, we can see that is the descriptive statistics that are generated from SPSS. Our descriptive analysis showed that the mean credit risk was 0.00813, with low variability indicating consistent risk control. After discussing the dependent loan loss provision among the 20 independent variables are the smallest mean falls to loan loss provision with a value of 0.007193, and its standard deviation is 0.001406. So this diagram shows the correlations of each variable against our dependent variable, which is credit risk. From the diagram shown in the previous slide, all the variables can be categorized into three sections. It is the significant negative correlations, significant positive correlation, and do not show any significant relationships. The first one will be the significant negative correlations. These are the variables that move in the opposite direction of credit risk. In other words, when this variable increases, credit risk tends to decrease. The first one will be return on assets. This means more profitable the bank is, the lower the credit risk. It makes sense because strong profits often indicate healthier operations and better risk management. Secondly, it will be firm size. Larger banks like Hong Leong Bank Berhad can spread their risk across more clients and products, which helps reduce exposure to credit risk. The next one will be the debt to asset ratio. This could be because Hong Leong Bank Berhad manages its leverage carefully and uses debt in a sustainable way. Followed by the exchange rate. This suggests that when the currency is stable, Hong Leong Bank Berhad experiences less credit volatility, especially for borrowers with foreign currency loans. Next, it will be the liquidity. This makes sense because liquidity ensures the bank can absorb shock and meet obligations. Lastly, it will be regulatory capital. Strong capital buffers help the bank absorb losses and maintain stability. Next, we will have the significant positive correlation. There was only one clear case here. It is the loan loss provision. This is because when credit risk rises, the bank responds by increasing its provisions for bad loans. So, a higher loan loss provision often signals a higher expected risk of default in the loan book. Finally, we will have the variables which have no significant relationship to credit risk. These include inflation, GDP, and interest rates. Although they are important on macroeconomic indicators, in this study, they did not show a statistically meaningful impact on Hong Leong Bank Berhad's credit risk. This might be due to the bank's internal resilience and conservative lending practices, which help shield it from short-term economic fluctuations. Now we will discuss the model summary. The first one will be the internal factors. For the internal factors model, we achieve a very strong explanatory power. The R value is 0.981, showing a very high correlation between the predicted and actual credit risk values. The R square value is 0.963, meaning that 96.3% of the variation in credit risk can be explained by internal financial indicators such as ROA, liquidity, loan loss provision, and regulatory capital. The adjusted R square remains high at 0.888, reinforcing the model's reliability even when accounting for the number of predictors. The Durbin-Watson statistic is 2.217, indicating no autocorrelation in the residuals. Overall, internal factors alone are excellent predictors of credit risk at Hong Leong Bank Berhad. The second one will be external factors. When we analyzed only external macroeconomic indicators such as exchange rate, standard deviation, M2 money supply, and reserve money, the model was much weaker. The R value dropped to 0.361 with an R square of just 0.130, indicating that only 13% of the variation in credit risk is explained by these factors. The adjusted R squared was negative at negative 0.304, suggesting the model may be overfitted and lacks predictive power. Although the Durbin-Watson statistic was acceptable at 2.169, the overall takeaway is that external variables alone are not strong predictors of Hong Leong Bank Berhad's credit risk during this period. Lastly, it will be internal and external combined. When internal and external variables were combined, the model still performed well. The R value was 0.6961 and the R squared was 0.923, meaning 92.3% of the credit risk variation was explained by this integrated model. However, the adjusted R squared dropped to 0.654, suggesting some loss of model efficiency due to the number of variations and the limited sample size. The standard error remained low at 0.001233, and the Dubai-Watson statistic was 1.483. It is slightly low, which may indicate mild positive autocorrelation. Still, this combined model offers a broader and balanced view of credit risk behavior. Next, we will discuss on the coefficients. The first one will be internal factors. Looking into the regression coefficients of internal factors, loan loss provision was statistically significant with a p-value of 0.025. This confirms that higher provisioning is strongly associated with increased credit risk. Return on assets, liquidity, and the equity multiplier were borderline significant, with the p-values just above 0.05. Regulatory capital and capital adequacy ratio, however, were not significant in this model, suggesting their influence on credit risk is limited or indirect in Hong Leong Bank Berhad's context. Next, it will be external factors. For the external variables, none of the predictors were statistically significant. Their p-values were all well above 0.05, indicating that these macroeconomic factors did not have a measurable direct impact on Hong Leong Bank Berhad's credit risk during the study period. This reinforces the earlier model summary conclusion. External factors alone do not significantly drive credit risk in this case. Lastly, it will be the coefficients that internal and external factors combined. In the combined model, none of the individual variables were statistically significant. Although regulatory capital came close with a p-value of 0.054, the others, including loan loss provision, liquidity, equity multiplier, M2, and reserve money, were all well above 0.05 threshold. This suggested that while the combined model has good overall explanatory power, no single variable dominates the prediction. Instead, it's the collective effect of these variables that contributes to understanding Hong Leong Bank Berhad's credit risk profile. Now we will move to the section of discussion and conclusion. In summary, the study shows that internal factors have a stronger impact on Hong Leong Bank Berhad's credit risk than external ones. Loan loss provision was the most significant factor positively linked to credit risk, while firm size, liquidity, and Roy-Talo show negative relationships, indicating that efficiency, skill, and strong reserves help reduce credit exposure. On the other hand, macroeconomic factors like GDP, inflation, and interest rates had no significant impact except for the exchange rate, which showed a strong negative correlation with credit risk. Overall, Hong Leong Bank Berhad's credit risk is largely shaped by how it manages its internal operations through external risks, especially currency fluctuations should still be monitored. This highlights the importance of strong financial governance in sustaining long-term credit sustainability. Now we have come to the last section for this presentation, which is the recommendations. Based on the findings, here are several key recommendations for Hong Leong Bank Berhad. First, strengthen loan loss provisioning by using forward-looking credit models to anticipate defaults earlier. Second, improve financial efficiency by managing assets and costs more effectively. Third, maintain strong liquidity buffers to absorb short-term shocks and ensure lending stability. Fourth, monitor exchange rate exposure closely, especially for borrowers with foreign currency obligations. Lastly, Hong Leong Bank Berhad should complement its quantitative risk models with qualitative factors like digital risk and regulatory changes to better manage evolving credit challenges. That's about all for the study of the credit risk management against Hong Leong Bank Berhad. Thank you.